Welcome to the Pro Ticker Deep Dive. We are jumping straight into, well, a fascinating and frankly pretty confusing set of source material today. It's all focused on the mind-bending complexity of the Japanese consumer economy, specifically late summer, early autumn of 2025. Yeah, the core of this deep dive really centers on a massive contradiction we're seeing. The data reveals a true economic tug-of-war. So the question we really need to try and answer is simple. Are Japanese households splurging, ready to finally power a major recovery? Or are they tightening the belt, really feeling constrained by this stubborn price fatigue? Because honestly, we saw signs of both happening at the same time.
That conflicting signal is precisely it. That's what makes this analysis so critical right now. Our mission today is really to unpack why the August and September data showed such drastically mixed signals. You've got one economy seemingly ready to recover, maybe even celebrate a bit, and the other looks highly constrained, almost pulling in the opposite direction. And we aren't just looking for, say, temporary weakness here. We're trying to determine if this push-pull dynamic is actually something bigger, maybe a long-term structural rebalancing of consumer priorities. It could point to a really profound cultural shift in how value itself is defined.
Okay, let's unpack this with the raw numbers then. Because the August headline data, that's where the paradox really just jumps out at you, doesn't it? Overall, real retail sales, so the consumption of actual physical goods, dropped by 1.5% month over month. Now, that sounds weak. On its own, it sounds like consumers are pulling back.
It does sound weak, yeah. And that figure usually sends a few shivers through analysts, But critically, you cannot look at that number in isolation. You just can't, because in the very same month, consumption in the service sector surged. And I mean surged by a massive 3.8%. That's the core evidence of the paradox right there. Declining spending on things, but absolutely booming spending on experiences.
So if we look at those two figures together, it paints a picture of some really aggressive trade-offs being made. Households were clearly cutting back on physical items. The data shows autos, fuel, and especially food took hits.
Right.
But then they were aggressively prioritizing things like, dining out, beauty services, travel, leisure activities. It's almost like saying, okay, I'll skip buying those extra groceries this week so I can take the family out for a really nice meal.
Precisely. That's exactly the kind of choice it reflects. It shows the underlying desire to spend is absolutely there, but the consumer is applying a really strict filter. And this isn't just an economic shift, it feels more like a psychological one. Consumers seem to be defining discretionary spending less by material acquisition, getting new stuff, and more by the quality of the experience. So why should you, the listener, care about this split? Because it tells you where the future growth might lie in the Japanese market. It seems increasingly driven by, let's call it memory creation, not just manufacturing volume.
Okay, that makes sense. If we connect this to the bigger picture then, we need to understand what fueled this. Spending schizophrenia, you could almost call it. The sources seem to point to two major macro forces. We've kind of termed the push and the pull. Let's look at the push first, the confidence side. That optimism, that has to stem from the labor market, right? That seems foundational.
It does, largely. You've got labor market tightness, meaning, real competition for workers combined with pretty resilient corporate profits. And that translated into strong underlying income growth. Crucially, this showed up in very generous summer bonuses, big bonuses. That injected immediate short-term discretionary cash right into household accounts. And that directly funded that August service spending spree we saw. People had cash and they spent it on experiences.
But wait, let me just challenge that confidence theory for a moment. If income growth was really so strong from those bonuses, why did consumers immediately cut back on essentials like food and fuel? Doesn't that kind of contradict the confidence idea?
That's where the caution side comes into play.
Right.
And it's arguably the more powerful long-term force here.
You're absolutely right. The confidence seems compartmentalized. It's not across the board. Inflation, while it has cooled from those 2024 highs, remains stubbornly sticky. And when we say sticky, we mean the prices of necessities, things like electricity, transport, and specifically food, they just haven't come down enough.
Yeah.
Not enough to make those small daily trade-offs feel less painful. So that stubborn inflation weighs really heavily on household budgets, forcing caution, even when a consumer gets a nice one-off bonus check. Okay, and here's another layer to this complexity we should probably touch on: external disruptions. These seem to have disproportionately hit the goods economy. So, meaning some consumers might have wanted to buy things, but things just weren't available.
That's a critical nuance, yeah. Often missed when just looking at that headline retail drop. While, global supply chain issues are kind of an ongoing background noise, The sources specifically highlight the lingering delayed effects of those temporary tsunami-related production halts, the ones back in June and July. And this was compounded by factory shutdowns by some major auto manufacturers, too.
Right. So by the time August rolled around, the actual pipeline for big-ticket purchases, especially cars, was just restricted. Even if a consumer decided, okay, I want a new vehicle, the waiting lists were long, which only made that decline in major goods purchases look even worse.
Exactly. That supply constraint is absolutely key to understanding the full 7.8% tumble in motor vehicle sales month over month in August. It reflects a genuine supply issue colliding head-on with a household appetite that's already a bit hesitant, hesitant to make big commitments amid this lingering price uncertainty. And looking beyond cars, the data really confirms the severe impact of price fatigue on just daily necessities. Real food and beverage consumption fell more 0.9%. And that was for a second straight month. That really confirms rising prices are forcing people to scale back or maybe trade down on what they put in a shopping cart. Cheaper brands, perhaps? Fuel consumption also declined 1.7%. These aren't just blips. They look like behavioral changes that might stick around.
But it wasn't total gloom on the manufacturing side, was it? Were there any goods bright spots in August? Anything suggesting resilient demand in specific areas?
There were, yeah, surprisingly strong pockets, actually, which gives us some hope looking towards the autumn. General merchandise, so think apparel, household goods, department store items, that category actually rose 2.9%, which suggests at least some discretionary spending was flowing back into things like fashion and items for the home.
Okay, that's interesting. And this next detail is fascinating because it really shows how specific consumer triggers can be in Japan sometimes. Machinery and equipment was up 2.6%. And the main drivers weren't just, say, weather-related demand for air conditioners, which you might expect,
Yeah.
but a specific spike in IT products.
That's right. It's quite specific. This spike was linked directly to the impending end of Windows 10 support. So it's not really generalized optimism driving that. It's consumers reacting to a very clear, fixed deadline, one that's basically forcing them to upgrade equipment. It's a great example of demand being driven by, well, practical necessity or even a regulatory change rather than broad market confidence.
Yeah, that detail about a technical deadline driving consumption is key, isn't it? It suggests spending can be unlocked, but sometimes only with a very specific shove, so to speak. Now, if August was kind of the high water mark for celebrating with services, what happened when the holidays eased off? Let's pivot to September now.
Okay, September. Yeah, in September, we started to see the beginnings of a rebalancing, maybe tilting back slightly towards goods. The auto sector specifically reported a welcome rebound in new car sales, which suggests those immediate supply constraints we talked about were starting to ease up a bit. We also saw better performance in more defensive sectors like drugstores and supermarkets. Consumers were still cautious, definitely, but maybe replenishing essential stocks.
And conversely, what about the service sector, the powerhouse of August?
That started to soften, yeah. We saw leisure travel cool off quite significantly. Convenience store sales growth slowed down noticeably. And we even noted weakening ridership on the Shinkansen, the high-speed bullet train. All that suggests the really intense post-summer travel boom eased off, taking some of that immediate momentum out of the experience economy.
Okay, so we've charted the movement, the push and pull between August and September. What does this all mean for the near future then? Thinking Q4 heading into winter. Let's look at the key opportunities first, because the underlying economy is absolutely not collapsing here, is it?
No, definitely not. Opportunity number one, the resilient service sector. Even with that September cooling, the underlying sort of pent-up demand for things like package tours, international flights, high-end dining, it's still structurally strong, outperforming historical averages. You could argue it's the new baseline for that sector.
Okay, opportunity two, wage momentum. We saw those generous summer bonuses. And if corporate profits stay robust, which is a bit of an if but looks likely, we anticipate year-end bonuses could sustain those higher income levels well into the fourth quarter. And that's absolutely critical, isn't it, for keeping discretionary spending flowing?
It's crucial. Absolutely. And opportunity three, what we might call the durables comeback. That September rebound we saw in autos and electronics is a really important indicator. It hints that once the supply chain snags loosen up completely, there's probably significant pent-up demand just waiting to manifest, waiting to come out in those big-ticket categories through the autumn and maybe into the new year.
Right. However, to balance the picture, we have to address the crucial risks, the things that could derail this delicate rebalancing act. And the first one seems to be that inflation's bite. It remains the deepest wound, perhaps.
I think it is, yes.
Yeah.
Even these moderate price gains, we're still seeing in essentials. They're creating lasting behavioral changes. We're seeing clear signs of households trading down in food quality, maybe brand preference. It's a quiet but potentially permanent shift in grocery habits. And they are also demonstrably cutting back on things like fuel and maybe apparel, too. This fundamentally changes the composition of retail spending and just limits the size of the overall spending pie available.
Okay, risk number 2. That vulnerability to disruption. We talked about it with the auto sector. Those natural events like the tsunami impact, they just show how fragile consumption can be when it's dependent on manufacturing supply chains that are prone to shocks. When one part of the economy fails, it seems to drag down confidence elsewhere, too.
It certainly can ripple outwards. And finally, there's the tourism plateau risk. The energy from the World Expo is winding down now. And looking at the calendar, there are fewer long weekends through early winter. So travel consumption, which has really been the powerhouse of this whole experience shift, it could lose momentum. And if it does, we need other sectors to step up and fill that potential void.
Okay, let's shift focus slightly now to how financial markets are viewing all this complexity.
Yeah.
That's essential for understanding investor sentiment, right?
Yeah.
What's kind of fascinating here is that the Japanese retail index seems to have largely mirrored the mixed consumption data. How so?
Well, it's basically consolidating. It hasn't really chosen a clear direction, up or down, which suggests investors are essentially waiting for clearer, less contradictory signals before making big bets. And we see this cautiousness reflected in specific sector performance, too. Think about airlines and travel stocks. They peaked over the summer on those massive service numbers, right? But since then, they've seen modest pullbacks. And that's consistent with the softer September mobility data we mentioned, like the weakening Shinkansen ridership. It suggests the market realized that peak celebration moment was perhaps temporary.
But on the flip side, you mentioned defensive plays holding strong.
Exactly. Consumer staples. So that includes stocks of drugstores, supermarket chains. They're performing relatively well. Why? Because they tend to retain pricing power during inflationary times. People might buy cheaper brands of food, as we discussed, but they still buy necessities. That makes these sectors feel more dependable to investors right now.
Got it.
And maybe just a quick technical view for those interested.
Wow.
The Nikkei Consumer Discretionary Subindex, it's currently testing support around its 50-day moving average. Now, for those less familiar with market jargon, just think of the 50-day moving average as kind of the stock's short to medium-term comfort zone. If the index can solidly bounce off this level, hold above it. That would signal renewed optimism, renewed confidence from investors that this recovery trend, maybe skewed towards services, will hold into the year end.
Okay, so all of this analysis, it really brings us back to the ultimate takeaway, doesn't it?
Yeah.
Japan's current economic story isn't really about generalized weakness. It's much more about a targeted structural rebalancing act. Consumers are making very active trade-offs. You see them cutting back on material goods like maybe cars and some groceries, but spending quite freely on high-quality experiences and, well, comfort.
I think that's right. This truly is beginning to look less like a cycle and more like a long-term cultural transition, moving away from a primarily goods-based consumption model towards an experience-based one. The service sector, leisure, hospitality, digital entertainment too, that seems to be where the consumer is now defining and finding value.
And that transition, that brings us neatly to the final provocative thought for you, our listeners, as we move into the winter months. The critical question isn't really if consumers will spend, especially given that potential wage momentum, but what they will choose to spend on. And everything we're seeing suggests that this psychological preference for experiences will likely continue to take precedence over just acquiring more physical goods, which forces a pretty fundamental shift in how businesses need to think about reaching their customers.
Fantastic analysis, really digging into a fascinating and, as you said, truly contradictory set of data points there. Thank you for joining us today.
See y'all in the next Pro Ticker Deep Dive.